as defined by the NBER, that's technical definition of a recession, 2 quarters in a row of negative real GDP growth. Now, the real question, David, is this a prolonged recession? How bad is this recession? And what are the effects on your portfolio and the economy? Now, Goldman Sachs put out a table last, I think, week that shows that the average or the median recession over the last 50 years has lasted 4 quarters and has seen earnings drop by 14% on average. And now analysts out there are expecting earnings in the S&P 500 to grow by 9% this year. So there is this cognitive dissonance. I think it's very important. People are not prepared for what's coming, I believe.
The next target is 15,000, and it's probably going to trade down to 12,000, says Alfonso Peccatiello in his recent interview with Kitco News regarding Bitcoin. Is the coin bound to drop lower than it already has? Find out more about Bitcoin and the recent news on the financial markets and recession by hitting the subscribe button and giving this video a thumbs up. Now, let's get right into this. Alfonso Peccatiello is the writer of the ever-growing financial newsletter, The Macro Compass, and is a great economist at the same time. He recently talked about recession, inflation, financial markets, and the current economic scenario of the world in his interview with Kitco. He was initially asked about recession and if he thinks the second quarter of this year would be a negative one for the GDP. The real concern is the recession, and if it's real, and if at this point the world is actually living through one. Alfonso added that yes, it is going to be a negative quarter for the GDP, and that we are literally in a recession. Previous history of recession tells us that the longest one has lasted 4 quarters, and people lost their earnings by 14%, and right now the world is headed to a second consecutive negative quarter. Is this recession going to be a long one, and how bad is it going to be? Alfonso raised the concern that people are not prepared for what's coming. It could be one of the longest recessions the world has witnessed, and at the same time, it could also be the worst one. He talked about the government policy from 2021 and how that affected the GDP. During the lockdown days, the government had been sending out checks and cutting down on the taxes, increasing the buying power. The GDP increased because there was financial activity and people were purchasing goods. Recently, in 2022, that's just not happening. There are no longer checks being handed out, and the buying power has recently declined because of the hike in product prices. This has the GDP going down and the rate of recession going up. While this is Alfonso's part of the argument, there's also another aspect to the scenario. Government's short-term policy to fight low GDP back in 2021 might have been the reason for the inflation today. They printed money and handed it over to the masses for spending, resulting in the increase in demand. Now, when factories and production houses were shut in the lockdown, there was less supply to meet the demand, which ended up causing the prices to go up. The government still hasn't been able to recover from the inflation that they ended up causing themselves. And today, in the long run, the consequences are evident. There's an ever-growing recession due to the inflation that was caused. Alfonso also talked about the savings index of people before and after COVID. People had ample savings before the virus hit the world, and maybe back then, there wasn't a lot they could spend their savings on because earnings were still there, businesses were doing fine, and people weren't being fired due to cost cutting. But after COVID, the savings dropped to their lowest. Now, it's only natural that people don't have the savings to spend on luxuries, which contributes to the GDP dropping. However, there is a counter-argument to that as well. We can't say that everyone has lost jobs and sources of income, yet the savings are still low. That means people are still spending their money on utilities and even on luxuries. Alfonso added to this by saying that people are spending, but that's only to make ends meet. They're probably living tightly at this point, and under these circumstances, it's only natural that they have exhausted their savings and their credit card limits. This means that at this point, even if people are making purchases, it is still less than they used to before the inflation. What's worse in all of this scenario is wage inflation. While the Fed might be able to fight other kinds, wage inflation would be the toughest challenge. Alfonso was asked about his opinion on the overall CPI rates and wages and which one would drop faster. He believes that it all depends on energy-related commodities like gas and electricity. If they drop, then the CPI would naturally drop faster than wages, but if everything remains the same in the energy department, then wages would drop first. This would cause people to spend less, considering they are earning a little less than what they were earlier due to the energy crisis. Since the economic activity would slow down, it would eventually lead to a drop in the overall CPI as well. Alfonso also talked about the severity of this recession. There is no certainty about the time period and how long it will last, but the severity can be predicted, and according to Alfonso, if not more or less, it would be at least equal to the previous median that the world has seen over the last 50 years. This is nearly a 14% drop on the S&P 500 earnings and a loss of 4 quarters. These are the minimum predictions, and things can go worse than them. In 2008, the S&P 500 earnings drop was nearly 45%, which is way more significant than the recent prediction of just 14%. Alfonso explained that last year the peak of earnings was over 50%, and now it has dropped way low, all the way to the negative, and he believes that it would drop as low as -10. A drop in earnings of that level would mean a drop in GDP of nearly 2 to 3%, which he claims is very serious and nothing to be comfortable about. He believes that the Federal Reserve and the central bank would try to fight inflation, and they might be successful in doing so by causing a lot of collateral damage. Initially, things would look bad for the economy, and people who would have their wages cut, and companies who would lay off staff to make ends meet. But eventually, the sun will rise, and with some damage, inflation will be taken care of. He also added that every big recession in the last 50 years has resulted in the inflation coming down. So if this recession would be as severe as it looks, then it would eventually bring down the inflation and would then slowly bring the markets back to normal. Now, a very interesting question during the interview was which of the two is the lesser evil, inflation or recession? They are both bad for the economy and the market, but which would cause a comparatively higher damage? According to Alfonso, an inflation is better than a recession because during an inflation, it's possible for people to have their jobs on lower wages, which they can get an increment for to make ends meet. However, recessions are worse because the result would be a hike in prices with low supply. A scenario of recession would make people leave their jobs, sell their homes, and for companies to go completely bankrupt. Now, coming to the more important question, when to invest again, considering all the markets and the scenario. A great time to invest would be when the GDP is low or is surfing in the negatives, which is the current scenario when the GDP has dropped below -6. However, it would be wise to wait before the economic volatility settles down a little. Now, when things get better, what would be the best investment choice? Should you invest in real estate, currencies, stocks, or crypto? Today, the bond market stands relatively stronger and stable than other financial markets. According to the data that we have, bonds are doing worse than ever before, but still better than other markets. Alfonso encourages people to invest in bonds because he has been doing so as well. He's buying bonds because he thinks they will protect him in the upcoming recession. Finally, Alfonso talked about Bitcoin. He previously predicted that the coin would drop to 26K from 40 to 45K, and it is now touching 20K and even sometimes below that. He predicts that the coin now would fall to 15K and even lower. It is not the right time to lift the coin. He says that there is still some more pain that will be observed when it comes to Bitcoin in the next few months. This drop might be a heads up for many investors out there who are looking to invest in the coin because it is relatively very cheap at the moment, and from here, if it goes down, it wouldn't be that great percentage-wise. So investing at this point can be beneficial, but for people who invested at higher rates and are now observing the drop, it would only be a relief if they don't worry about it and wait for it to rise again before withdrawing. Do you agree with Alfonso that inflation is the lesser evil when compared to a recession? Let us know in the comments section below, and make sure that you like, subscribe, and share. Thanks for watching, and we'll see you in the next video.